Welcome back to the channel. Today we are breaking down a massive divergence currently unfolding in the global silver market. While mainstream financial media outlets and traditional analysts continue to blame dollar headwinds for the recent short-term volatility, a deep dive into the institutional data reveals a systemic drain on global vaults. Right now we are seeing a 5% drop in the SLV, but the teleprompters are missing the real underlying story. We are diving deep into the verified, publicly available filings from the London Bullion Market Association, the COMEX, and major primary silver producers to expose a structural mathematical deficit that the broader financial market is actively ignoring. Over the next 15 minutes, we will unpack exactly why a massive repricing event is already in motion for those who know where to look. Let us start with a critical, foundational development that went almost entirely unreported in Western financial media over the past few weeks. Russia has officially enacted Federal Law 419-FZ. This specific legislation allocates a staggering $640 million annually, dedicated solely for the strategic state acquisition of silver, platinum, and palladium. Understand that the Russian Federation is not simply buying paper contracts to trade for fiat currency. They are aggressively draining physical metal to build a permanent, sovereign strategic reserve. This relentless accumulation represents a foundational shift in global physical supply dynamics when a major geopolitical superpower commits hundreds of millions of dollars annually to sweep physical silver entirely off the open market. The available free float shrinks exponentially. They clearly recognize that silver is severely underpriced relative to its critical, irreplaceable role in advanced future technologies. This is absolutely not a short-term trade for them. It is a vital, long-term strategic imperative designed to secure national interests. Meanwhile, mainstream analysts remain completely asleep at the wheel, heavily relying on outdated pricing models. But the hard filings and vault receipts do not lie. The physical reality of supply and demand is fundamentally and permanently decoupling from the leveraged paper market. If you pay strict attention to the actual flow of physical capital rather than daily digital price fluctuations, the inevitable conclusion becomes incredibly obvious to any serious investor making moves right now. The massive supply squeeze has begun. Moving on to the London Bullion Market Association, the situation is flashing red. Recent verified data clearly shows that vault holdings have collapsed by over 7,200 tons. This is absolutely not a rounding error or a minor seasonal fluctuation. This is a historic hemorrhage of physical metal. Where exactly is this silver going? It is moving rapidly into unreported private storage in secretive global jurisdictions. Institutional players are quietly taking delivery. The LBMA has traditionally been the solid bedrock of global silver liquidity, but this massive drawdown exposes a severe structural vulnerability. When 7,200 tons simply vanish from the registered tracking system, the fractional reserve nature of the market is finally laid bare. The paper price on your screen reflects a market of infinite supply, but the physical reality within these vaults tells a story of acute scarcity. We are witnessing a silent run on the bank. Smart money is converting paper promises into hard, unencumbered physical assets daily. The vault collapse is the ultimate leading indicator of a systemic and impending massive repricing event that will shake the entire commodity sector. Now, let us closely examine the glaring disconnect between recent retail panic and strategic institutional positioning. Just recently, the iShares Silver Trust, commonly known as the SLV, experienced a sharp 5% drop accompanied by truly massive outflows. Retail investors, clearly spooked by the ongoing screen price weakness, are aggressively dumping their shares into the open market. But if we look under the hood at verified institutional filings, a completely different and highly revealing picture emerges. Elite hedge funds and global central banks are utilizing this tactical paper price weakness as a highly lucrative exit liquidity pool. The severe SLV outflows are essentially transferring massive silver exposure directly from weak retail hands into the strong vaults of institutional accumulators. The true stress test of the global pricing system is happening right now on the COMEX. The delivery notice is the only metric that tells the truth. COMEX silver delivery pressure has reached a critical, unprecedented 464.9% ratio against registered deliverable supply. The claims for physical delivery outnumber the actual available registered metal by more than 4.5 times. Major industrial end users and sovereign strategic acquirers can no longer trust the paper derivative. They need the physical raw material immediately. If even a small fraction of these demands are legally enforced, the COMEX will face a severe liquidity crisis, forcing a rapid upward repricing. This brings us to the Commitment of Traders report, which reveals a highly dangerous commercial short powder keg. The bullion banks and massive commercial hedgers have historically maintained strict control over the pricing structure by routinely layering massive short positions during any rally. However, the unique fundamental dynamics of 2026 have now firmly trapped these legacy shorts. they face an incredibly inelastic physical demand curve. The swap dealers have a concentrated net short position, but the physical buffer required to defend those strikes is evaporating, evidenced by vault drains. If the physical squeeze intensifies, these entities will be forced to cover their positions in an illiquid market, creating conditions for a violent short squeeze. We are looking directly at the mathematical probability of a massive parabolic price shock. The commercial shorts are essentially holding a lit stick of dynamite. With foreign central banks and industrial giants absorbing every dip, the traditional exit strategy for these commercial shorts is entirely closed off. Compounding this crisis is a profound failure on the production side. Let's look at internal modeling from major miners like Hecla and Pan American Silver. Despite lower production due to declining ore grades, their modeling reveals a $50 per ounce floor assumption for any future capital allocation. Why establish a $50 floor when the spot price is lower? Because they see massive underlying supply cracks forming in real time. Global silver mine supply has flatlined for a decade due to underinvestment, permitting delays, and the harsh reality of lower yield mineral deposits. The vast majority of silver is mined as a byproduct of copper and zinc. Primary miners have little elasticity to ramp up production quickly. The era of cheap, abundant silver supply is officially and permanently over. Physical industrial demand is now entering an explosive new paradigm. Silver accounts for 29% of solar panel costs. The green energy transition is heavily dependent on silver, the most conductive metal on Earth. There is no commercially viable substitute. This creates a state of highly inelastic demand where manufacturers must purchase silver regardless of the spot price. The volume of new energy gigawatts being installed globally, particularly in China, requires thousands of tons of physical metal annually. As technology shifts, silver intensity per panel is increasing. This massive industrial consumption operates entirely outside the financialized paper futures market. Manufacturers are draining vaults to meet immediate fabrication requirements, effectively removing thousands of tons from the global investment pool every year. The scale of the solar industry alone is enough to destabilize the historical supply and demand equilibrium forever. As if the massive solar deficit was not enough to break the market, the year 2026 has firmly solidified a completely new, massive, and unexpected demand layer, the collision of artificial intelligence and nuclear power infrastructure. Major global technology giants like Meta and Microsoft are currently rapidly locking in advanced nuclear capacity simply to power their dense AI data centers. What the mainstream financial media fails to mention is that these advanced nuclear reactors and transmission infrastructure are incredibly silver-intensive to construct and operate. From specialized control rod alloys to heavy-duty industrial switches and massive internal conductive pathways, physical silver is absolutely irreplaceable in high-stakes electrical engineering. The desperate global race for artificial intelligence supremacy is directly translating into a frantic race for secure, uninterrupted baseload energy generation. As these multi-trillion-dollar companies deploy capital into nuclear facilities, they are unknowingly competing with the solar industry and electric vehicle manufacturers. They are all fighting for the exact same rapidly shrinking pool of physical silver. This creates a perfect, unprecedented storm of compounding demand vectors. We are witnessing the collision of the green energy transition, the AI revolution, and the rebuilding of our aging national electrical grids. None of these megatrends can advance without securing massive quantities of physical silver, rendering the current leveraged derivative pricing model completely structurally obsolete today. To provide a truly balanced and thoroughly advanced analysis, we must actively address the prevailing mainstream bear case. The traditional bearish argument for the remainder of 2026 primarily hinges on persistent dollar headwinds and a persistently hawkish Federal Reserve policy. Bears argue that a severe global macroeconomic recession could theoretically crush industrial demand, dragging the underlying silver spot price down with it. However, this entire bearish thesis fundamentally and completely misunderstands the new reality of incredibly inelastic demand emerging in the current decade. While a recession might slow consumer electronics, it will not halt sovereign strategic buying or the government-subsidized build-out of critical energy infrastructure. Furthermore, any severe economic contraction would force massive central bank liquidity injections, reigniting the safe haven demand for all hard precious metals. The mathematical reality is that the current physical supply deficit is so deeply entrenched that even a drop in demand would barely close the gap. Beyond pure economics, the fractured geopolitical landscape of 2026 is adding massive risk premiums to physical commodities globally. Specifically focusing on critical vulnerabilities like the Strait of Hormuz, any military escalation immediately disrupts the complex supply chains of base metals. Because silver is predominantly a byproduct of copper, lead, and zinc mining, any disruption in base metal logistics translates directly into a silver shock. As international supply chains regionalize, nations are aggressively hoarding scarce resources. This is a direct response to this profound geopolitical fragility. Rising geopolitical instability transforms silver from a simple industrial input into an absolute national security imperative, accelerating the drain on Western inventories. In a volatile world, the ultimate safe haven remains an unencumbered, highly liquid physical commodity. Sovereign nations are aggressively front-running the market. Let us examine how legacy institutions misprice this dynamic. We frequently see targets from major banks projecting mild, sideways consolidation. A prime example is the miss by Citi analysts who modeled oversupply based on outdated recycling metrics and underestimated green energy demand. These models are flawed because they input paper exchange data as physical reality. They calculate market balance without factoring in massive, unreported hoarding. Relying on legacy algorithms, they remain blind to the paradigm shift. However, independent quant funds project a radically different trajectory. For those tracking real-time inventory drains, the current price represents a historical market failure. The massive disconnect presents an asymmetric investment opportunity. The algorithmic models of these banks are designed for abundance, not an era of physical scarcity. They fail to understand that when an asset becomes a strategic necessity, the price elasticity of demand approaches zero. Synthesizing this vast array of critical data points brings us to a singular conclusion. A violent upward repricing of global silver is mathematically inevitable. Let us review the facts. We have documented the LBMA suddenly losing well over 7,200 tons of its critical inventory. We have actively seen the COMEX currently operating with an absolutely unprecedented delivery pressure ratio of exactly 464.9%. The Russian government is aggressively deploying $640 million annually into strategic physical accumulation under Federal Law 419 FZ. Major primary miners are actively establishing a hard, non-negotiable $50 price floor simply for their basic operational viability. Highly inelastic solar demand is consuming 29% of production, compounded by the explosive energy requirements of the artificial intelligence revolution. Working together simultaneously, they undeniably represent a complete systemic reordering of the entire global commodity market. The daily screen price you see today is nothing more than a deeply flawed lagging indicator, artificially manipulated by desperate commercial shorts. The transition from a leveraged paper price to a purely physically discovered price is historically a highly chaotic process. We are now entering the absolute terminal phase of that turbulent transition. The relentless systemic drain mathematically guarantees a massive price spike. In summary, the temporary weakness in the silver paper market is a carefully orchestrated illusion designed to provide exit liquidity for large institutions. The physical delivery notice is the ultimate truth teller, and the vaults are flashing severe warning signs of a complete inventory depletion. For the remainder of 2026, the pressure will only build as industrial consumption and sovereign accumulation extract the remaining supply. If you found this data-driven breakdown helpful, please take a moment to hit the like button, share this, and subscribe to the channel.